Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
So you're a pretty successful investor. You feel like you've got your taxes down pat. You know all about capital gains, you know your income bracket. But what if I told you there's an extra 3.8% tax lurking in the fine print? It's one that catches even the most savvy investors completely by surprise. And that's exactly what we're going to break down today. And this question, it's the perfect example of the confusion out there. This investor, they did everything right. They even lived in a no-tax state, and they still got hit with a bill they never ever saw coming. It is a classic "wait, what?" moment that we are going to clear up for you right now. So that really is the big question we're answering in this explainer, isn't it? Is there some kind of hidden tax just waiting to take a bite out of your portfolio? Well, the short answer is maybe. But the good news is, once you actually understand how it works, you can absolutely plan for it. All right, let's get into the rules of the game, because you can't avoid a penalty if you don't even know what the rules are, right? We need to understand what this tax is, who it applies to, and how it gets calculated. It does have a name, the NIIT. So here it is, the Net Investment Income Tax, or NIIT for short. The best way to think about it is as a surtax. That means it's an extra tax that gets tacked on top of your regular income taxes and your capital gains taxes. But here's the key, it only applies if you meet two very specific conditions. The test to see if you actually owe this tax is surprisingly simple. It really just comes down to a two-part test. First, we look at your overall income. If that's high enough, then we look to see if you have the specific kind of investment income that this tax targets. And here's the most important part. You have to check both of those boxes to be on the hook. Okay, so step one, the income thresholds. The magic number for your adjusted gross income, or AGI, is over $200,000 if you're single, or over $250,000 if you're married and filing jointly. Now, if your income is below these levels, you can just breathe a sigh of relief. The NIIT doesn't apply to you, period. Now for step two. Let's say your income is above that threshold. The very next question is, do you have net investment income? And the answer comes down to this really crucial distinction. The tax hits all the usual suspects, right? Capital gains, dividends, rental income. But what's exempt from the tax is way more interesting. We're talking about withdrawals from your IRA or 401k, your regular salary, even life insurance payouts. You know, understanding this difference is the secret key to our entire playbook. So you've looked at the rules, you've determined you might actually be liable for this tax. Now what do? Well, this is where it gets good. Let's dive into the playbook and see how you can legally and strategically minimize or maybe even completely avoid the NIIT. So let's get right into it. We've got 8 distinct strategies in our playbook. These range from some pretty simple portfolio tweaks you can make today to some more advanced moves for folks who own businesses or real estate. First up, the foundational strategies. One of the simplest moves is just investing in municipal bonds. Why? Because their interest is often tax exempt, so it sidesteps the NIIT completely. Second, if you're charitably inclined and you're sitting on a stock that's gone way up in value, don't sell it. Donate it directly. You get to avoid the capital gains tax and the NIIT, and you still get a deduction. And third, a strategy of patience. If you can, just wait to sell an asset with a huge gain until a year when your overall income might be a little lower. Now, for all you real estate investors out there, the next tool in our playbook is a true game changer. It's a special provision in the tax code, and it's called the 1031 exchange. Okay, here's the magic of the 1031 exchange. It lets you sell an investment property and then roll the full proceeds into a brand new one, and you defer all the capital gains tax. So think about it. If there's no taxable gain being recognized on paper, there's no investment income for the NIIT to tax. That means the 3.8% on that sale just vanishes. You can potentially keep doing this, kicking that tax can down the road for years, maybe even decades. Hey, remember on that earlier slide how we pointed out that certain types of accounts were exempt? Yeah, that was not an accident. The tax code is specifically set up to reward you for using certain long-term saving vehicles. So let's see how this builds our defense against the NIIT. Life insurance and annuities are two fantastic examples of this. The cash value that grows inside these products, it grows tax-deferred. So you're not getting hit with the NIIT on that growth year after year. And the death benefit from a life insurance policy, it's paid out completely free from this tax. It's really all about structuring your investments in the right kind of wrapper. All right, let's circle back to real estate for a minute, because there's another incredibly effective strategy here. But this one, it requires a little more commitment. It involves actually changing how the IRS sees you, from being just a passive investor to being an active professional. This is what's known as the real estate professional status. Basically, if you spend a significant chunk of your working time on real estate activities, you can qualify for this designation. And the benefit? It's huge. Your rental income is no longer considered passive investment income. It gets reclassified as active business income. And the impact of that is just profound. By changing your rental profits from passive to active business income, you can potentially pull that entire stream of money right out of the NIIT calculation. You're basically telling the IRS, hey, this isn't a passive investment for me. This is my job. And income from your job isn't subject to this particular surtax. And finally, a slightly humorous but mathematically true point from our source material. Remember those income thresholds? A single person gets a $200,000 threshold, but a married couple only gets $250,000, not $400,000. It creates what's known as a marriage penalty, where two high-earning people might have to pay the tax when they're married, but not if they were single. Now, the source jokingly suggests avoiding marriage, but of course, we're just pointing out a very interesting quirk in the tax code. Okay, wow, we have covered a lot of ground. So let's just take a moment and distill all of this down into the most important, actionable takeaways from this entire explainer. If you remember nothing else from this, remember these 3 pillars. First, max out those retirement accounts. Your 401k, your IRA, their growth and withdrawals are exempt. Second, look into vehicles like life insurance for tax-deferred growth. And third, if you're in real estate, the 1031 exchange and that professional status, those are your superpowers. And to really drive home why this matters, just look at this real-world example. Somebody sells a property in Korea, and they pay a ton of local taxes over there. They assume they're all clear with the IRS because of foreign tax credits. But then, boom, they get a separate bill for the 3.8% NIIT right here in the U.S. It just shows how widespread and totally unexpected this tax can be if you're not prepared for it. And that really brings us to our final question for you. Now that you know what the NIIT is and you have the playbook for addressing it, it's time to take a hard look at your own situation. Is your portfolio structured to defend against this 3.8% tax, or could you be in for a surprise come tax time?